A calm before the storm. It's Monday evening, January 19th, 2026, and there's something unfolding that most people won't recognize until the damage is already done. I'm a private commodities analyst. I've spent the last 12 years tracking the physical metals and banking markets. If you're curious about who's actually behind this AI persona, you can find the channel intro on the homepage. But right now, that background doesn't matter. What matters is timing. While most of the world is distracted, watching football, scrolling their phones, the global physical silver financial system is slamming into a hard wall. On Friday afternoon, mainstream financial media focused on the Greenland real estate deal. They framed it as geopolitics. They called it diplomacy. They threw around phrases like negotiation strategy and trade leverage. That's the narrative, not the reality. This isn't about a country. It's not about Arctic minerals. It's not even about what tomorrow's Wall Street Journal headlines will claim. This is about strategic positioning beneath the surface, a physical liquidity trap that is now tearing through the London Bullion Market Association. And once the LBMA fractures, the entire global silver pricing mechanism follows. This is how it happened. On Friday evening, the government dropped what I call a tariff bomb for nuclear weapons. From 1st February, imports from 8 EU countries and the UK will be subject to a 10% tariff. That was 14 days later. Here's a point that will make you feel cold. This list also includes the United Kingdom, which is home to the LBMA, London Silver Mining Authority, which is the world's most important silver trading center, in addition to New York. When the futures market opens tomorrow evening, silver's economic route across the Atlantic will not only be expensive. Precious metals banks are financially unable to maintain their established operating methods. But that's not the worst part. I want to be very clear about what I am arguing here, because this is not speculation. It's math. Trump's 10% tariff if the Greenland agreement is not reached by June 1st will rise to 25%, forming a so-called one-way valve in the global silver market. This effectively trapped millions of ounces of physical silver in the United States, causing the London market to starve due to existing stocks. It's a bet. If LBMA can't borrow metal from COMEX's vault in New York to cover their shorts, the global pricing mechanism will collapse completely. We are not talking about squeezing the price of silver from $90 to $110. We are talking about a fundamental rupture in the global value of this metal. We are considering a situation where physical silver is legally allowed to trade at more than $100 per ounce, not because of investment demand, but because the supply chain is structurally impossible. I'll go through 3 things in this video. First, I want to explain how exactly this geo-arbitrage works and why it is more important than any other factor in the current silver market. Second, we need to use actual stress estimation to calculate what happens when that 10% becomes 25%. Third, I'm going to share my personal campaign plans for Monday Open and the next 14 days, because I've been in the market long enough to know that when the music stops, you should sit down. Before we continue, there is one thing you need to understand. Gold is the king's currency, central bank holding. Governments hoard these resources. It is the anchor of the monetary system. But silver is the Achilles heel of the entire banking system. That heel was about to be hit by an arrow. I'll give you accurate data. This afternoon, around 2:30 p.m. EST, silver was trading at $89.94, down 1.62% from Friday's close. Gold was trading at $4,596.87, down 0.28%. If you only look at these numbers, you might think that the market's reaction is rational. Tariffs usually represent a stronger dollar, and precious metals usually fall from the strong dollar with the news. The algorithm detects the tariff and monitors it according to its standard operating instructions. But the paper market does not yet understand this, the physical reality that is happening under those signs. Although paper prices fell slightly on Friday, the bit-sell divergence began to widen. Not dramatic and won't trigger a CNBC alert, but if you look at the brick-and-mortar store, you'll see it. The gap between what someone is willing to pay for an ounce and what someone is willing to sell is starting to widen. And as a surprise on Friday night, the customs announcement announced after the LBMA closed over the weekend. London doesn't even know she's trapped. I'll give you some background to make this even crazier. In the first quarter of 2025, we saw tens of millions of ounces of physical silver escaping from the vaults of London and falling into New York. Harkopanki thought it was smart. They contribute to the forthcoming Section 232 review. Section 232 review is a mechanism used by the government to assess whether imports pose a threat to national security. Silver as a strategic mineral is apparently on this list for many uses, from solar panels to missiles. So the bank did what a bank is supposed to do. They pushed the metal beyond its potential limits. They moved the physical warehouse from the LBMA to the communication warehouses, believing that it would avoid supply chain disruptions. Now, with just one notification and one weekend tweet, the door is locked from the outside. Metals are stuck in New York, and banks have lost the ability to play with the shortages on the other side of the Atlantic. How geo-arbitrage cases actually work. Let's slow down. I'll teach you a concept that most retail investors have never heard of, but institutional traders stick to. This is called geographical arbitrage. A simple definition is as follows. This happens when the cost of transferring assets between two global exchanges is higher than the price difference between these exchanges. When this happens, the flow of water is completely paralyzed. I'll give you a parable to make this clear. Imagine that you have two wallets. Your left pocket, let's call it London, is completely empty, and you have to pay the bill right away. Your right pocket, New York, is filled with $100 bills. Usually the problem can be solved by transferring cash from the right pocket to the left pocket. But here's the key. Every time you transfer a $100 bill from your right pocket to your left pocket, the government intercepts it and imposes a $25 tax. You are rich on one side and practically bankrupt on the other. You cannot solve this problem, otherwise you will lose 25% of your wealth. It is its geographical arbitrage. Now this is applied to today's silver market. The UK, particularly the LBMA, is experiencing a severe shortage of physical silver resources. They are responsible. They have contracts. They have supply needs from funds and industrial users who need the right metal, not promises on paper. Under normal circumstances, this would not be a problem at all. When there was a shortage in London, they arranged broadcasts from New York. Metal music crosses the Atlantic every week. This is part of the global flow that keeps prices in sync between exchanges. This is how the organization works. If silver is traded at $90 in New York and $91 in London, the arbitrage trader buys it in New York, sends it to London, and sells it for a $1 profit, deducting freight costs and then taking the difference. The continuous flow of metals from low to high prices is the key to maintaining the balance of the global market. But if the tariffs are up to 10% and eventually 25%, the metal will never be able to economically return to the United States, otherwise the banks will suffer huge losses. Think about what this means. If you're a precious metals bank that sends 1 million ounces from New York to London to cover a short amount, you'll make the price of this metal 25% more than the cost of bringing it back. As a result, two different prices of silver are coming to the fore. I call them trapped American prices and hungry London prices. When these two prices are decoupled and the arbitrage mechanism collapses completely, we see a phenomenon that has not yet occurred in the modern precious metals market. I go through the actual mathematics because it turns theory into reality. Scenario A, 10% friction. At $90 per ounce, a 10% tariff would increase import costs to the United States by $9 per ounce. What does this actually mean? This means that if silver is exchanged for $90 in New York and $95 in London, transporting the metal from London to New York is still not cost-effective because you will pay a $9 duty and lose $4 in the trade. This immediately created a result for physical metals in the United States. Domestic silver prices cannot be lower than London prices minus customs costs, otherwise arbitrage will step in and prices will be balanced. But this is where it gets dangerous. Scenario B, 25% nuclear option. If the Greenland agreement is not reached by June 1, and I personally consider the likelihood of an agreement to be lower than the media claims, the cost of transporting silver back to the United States will increase at current prices by $22.50 per ounce. I'll say it again, $22.50, 50 cents per ounce. LBMA is rumored to be very short-lived. I don't have exact numbers as banks don't immediately short-sell positions, but based on the inventory reduction we saw in the first quarter of 2025, the potential exposure range could be 50 million ounces or more. If they need 5,000 ounces to meet their supply obligations and the United States is the only available source of physical metals, the surcharge required to transport these metals must exceed the 25% tariff. Here's a calculation that will scare anyone who is currently shorting silver. It is currently priced at $89.94. Add 25%. That makes 11,242s. This is the mathematical equilibrium point for the global silver cycle in the 25% tariff scenario. $11,240 is not a speculative target price. This is not an optimistic prediction for a gold enthusiast who believes that the US dollar will collapse. This is the lowest price required for arbitrage to operate in the new tariff structure. Now look at the stock chart of COMEX. I watched it a few hours ago. Here's what you need to know. Movable registered silverware, i.e. portable metal, did not move. It's there. Not because there is no demand, but because the banks cannot let these funds drain. For every ounce flowing out of the US vaults, replacement costs increase by 25%. Smart money has long seen through this. They don't sell. They are not sent. They sat on top of the metal, waiting for London to blink. Now, I know exactly what the skeptics are saying. I've been in this industry long enough to anticipate objections before they appear in the comment section. Skeptics. Firstly, this is only Greenland's negotiating strategy. Silver is a strategic mineral. It has been released until February 1. Here is my objection. Look at the Section 232 amendment that was completed a few days ago. Read the correct language. It deliberately leaves room for extensive tariffs from all the countries listed. If the government wants to release strategic minerals, it has already done so from the original announcement. Their term, all commodities, is no coincidence. It is a pressure tactic aimed at maximizing financial pain and forcing concessions. There is a bit of a negotiation strategy in it. These methods only work if the other party believes that you will actually keep your promises. If you declare a 10% duty, gradually increase it to 25%, and immediately grant a derogation, you are already in a situation. You've revealed that it's just a bluff. This government is not bluffing about tariffs. We've seen this before. The skeptic's argument, too: Great Britain is no longer even in the EU. Customs duties do not apply to them. Wrong. The announcement clearly placed the UK alongside the EU countries. Read the press release again. All this is written in black and white books. 8 EU countries plus the United Kingdom. Brexit does not protect London from this. On the contrary, it makes them more vulnerable, as they do not have the collective bargaining power of the EU to negotiate exemptions. The skeptic's argument is threefold. Comics only change the rules. They allow cash payment or adjust shipping terms to avoid condensation. That actually makes sense. The trading floor has also changed the rules in the past during times of tension. But skeptics forget one thing: changing the rules does not produce physical metals. If the LBMA agreement requires physical delivery and the metal is not obtained due to tariff traps, no rule change in New York will solve their problem in London. You can't use PDFs to resolve physical service obligations. I want to share my personal dashboard for the next 14 days as this is moving forward quickly. First, I'll focus on the growth of manga profits. I expect to receive it on Tuesday or Wednesday. When volatility increases or exchanges sense a squeeze is forming, they raise margin requirements to eliminate small skeulants. This is the normal procedure. If you're trading silver futures with leverage, a 20% or 30% margin increase could force you to either put in more cash or liquidate your position. This is how they organize a sell-off in the banknote market when the physical market tightens. Secondly, I pay attention to the media, because I call it a lockdown when the banks are in real danger. You can see that the topic is either completely silent or there are technical issues with the reporting. Note London's redefinition of what is usable silver. They start separating the allocated and the unallocated, or start talking about liquidity instead of inventory. It's a shell game with a tongue that masks the fact that the metal is running out. Third, and most importantly, I follow the spread of EFP. EFP stands for Exchange for Physical. This is a mechanism that allows traders to exchange futures contracts for physical metals. The spread between futures and physical prices is usually very narrow, probably only a few points. If this spread increases to $1, $2, or $5 per ounce, it means that the paper market has completely disconnected from the physical market. This is a sign that the system is crashing. Fourthly, I look at every headline in Greenland. Any sign of a breakdown in the negotiations or a statement by the Danish authorities that the negotiations have stalled is an optimistic sign for silverware. As every day without a deal is closer to the day when the 10% tariff comes into effect on February. And after June 1st, every day without an agreement will be another day under the 25% interest rate system. And the banks will have 14 days to solve this problem, which has accumulated for 100 years. They cover up physical flaws with derivatives, leases, and accounting methods that allow them to calculate the same ounce of silver in 3 different locations. But you can't escape physics with the help of tariffs. Time is not on their side. This is my personal battle plan for the next 2 weeks. Before I tell you, I want to be very clear about one thing. I'm not your financial advisor. I'm not going to tell you how to spend your money. I'm a person who has been collecting physical silver coins for over a decade, and now I'm watching the train derail in slow motion. This is my personal handbook. You do what suits your situation. The first trigger point, the $92 level. If the futures market opens on Sunday evening, and the futures market reopens, and the silver price divergence crosses $92, I believe this is proof that the market is setting the tariff trap. This would represent a breakthrough from the recent consolidation area. More importantly, this shows that institutional money is starting to price geographic arbitrage. If that happens, I have a nuclear physical drive and I don't intend to sell. I don't care if it reaches 100 or not. I don't care if it reaches 120 or not. The metal is left in the safe. Trigger number 2 to register inventory movements. I stared at the COMEX warehouse report like an eagle. These lists are published daily and show the exact number of credits registered and completed in eligible categories. Registered agents can submit futures contracts. A qualified representative is simply placed in the warehouse, but he is not assigned to delivery. If I see a lot of silver moving from registered to valid, it means that big companies are hiding their metals. They want to take this off the negotiating table. They made it unusable for a future emergency departure. This is an upward signal. The third trigger point, which is just a bluff title. If the price of silver falls to $85 this week because the mainstream media reports that this is just a negotiation strategy, calm and rationality will prevail. And I personally hope to be able to raise my physical currency. I'll take it as a gift. This is the last chance the market gives me to buy at a discount before reality takes shape. I'm not talking about chips. I'm not talking about futures contracts or options. I'm talking about physical metal that you can hold in your hand. Trigger point 4, the difference exceeds 20%. If the manga's profit margin exceeds 20% per day, I can just sit idle. I'm not going to play paper games then. Margin increases are a signal for exchanges to try to stifle prices and force speculators to leave. When they are so intense, it usually means that the physical condition is more serious than it seems. That's when I let the physical metal do the work. I'm not trying to get around this problem. Launch point 5, ammunition in London and New York. This is the kernel option indicator. If the difference between the spot price in London and the spot price in New York reaches 5% or more, I will prepare for a big event. Force majeure is a legal term that refers to the inability to deliver deliveries due to circumstances beyond its control. This is an escape from the stock market when it is unable to meet its obligations. If this difference reaches 5%, it means that the arbitrage has completely collapsed. This indicates that the one-way valve is completely closed. This means that we have entered uncharted territory. At that point, my personal plan was simple. Hold the interview face-to-face, avoid paper, and wait for the dust to settle. What are the banks actually afraid of? I want to reveal something that is rarely discussed in the world of silver coins. Gold bar banks are not afraid of high silver prices. In 2011, they saw a silver coin worth $49. They successfully survived higher gold prices. They can be hedges, they can adjust accounts. They were concerned about a market that couldn't get the metal to where it was needed. The entire system of partial reserves of precious metals depends on geographical flexibility. When London became cramped, metal flowed out of New York. As New York tightens, metals flow out of Zurich, Singapore, or Hong Kong. This is a global shell game, and it is only effective if the shell can move freely. When one of the main shells is locked, the whole illusion is shattered. And this is precisely the effect of this tariff. It has locked the shell of New York. LBMA can no longer borrow from COMEX, and the price is also economical. Otherwise, you will suffer huge losses back and forth. So, what do? They have 3 options, and none of them are good. Option 1, they allowed London's physical silver to rise above $100 to encourage existing holders to sell. Another option is to change the rules to allow cash settlements, which destroys confidence in the entire LBMA system. The third option is for them to declare a serious use of force and admit that they are unable to fulfill their delivery obligations. The choice is yours. These options are devastating for the paper and silver markets, and each of them is optimistic about those who own physical metals, which is a frontline scandal. They don't want you to remember. Here's the context that makes the whole situation even more ridiculous. In the first quarter of 2025, we saw a huge flow of silver mining from London to New York. I said it before, but I wanted to go deeper into what really happened. The bank knows that a Section 232 audit is coming. They knew that silver would be classified as a strategic mineral. They know that import restrictions are possible. So what did they do? They moved the metal in advance. Tens of millions of ounces of COMEX flowed from the vaults of the LBMA to the comic book warehouses in New York City. This is the largest quarterly movement of silver coins between the two markets in recent years. And the irony is that they think they're smart. They thought they were enforcing restrictions on the front line. They thought they were on the right side of the trade when the tariffs came into effect. But they made a significant miscalculation. They thought that the tariffs would restrict imports into the United States, not exports. They shipped the metal to the United States to protect it from import duties. Now they understand that it is the exit that is really trapped. It's like a bank robber who breaks into a vault, stuffs money into a bag, and discovers that the only exit is locked from the outside. They are trapped. The best part is that they do it themselves. Why this week is different from previous squeeze attempts. I have participated in many silver medal competitions. I was at the peak of 2011. I've seen countless moon landing predictions fade. I know that many people in the silver circle have a cynicism towards the narrative of squeezing. We have all heard of this. Here it is. That is the most important thing. In the end, the bank collapsed and nothing happened. Prices went up for a week, the banks went down again, and we were back to square one. So let me tell you why this time is structurally different. Every previous pressing attempt has been demand-driven. This has always been a problem where investment demand exceeds supply. This has been an influx of retail buyers or hedge funds into the market in an effort to monopolize physical metals. And every time, the bank's response was the same. They have less paper. They lease metals from central banks. They move physical inventory from other global vaults to places where the pressure is increasing. They have always used geographical flexibility as an entrance and exit. This time the release valve is gone. It is not a question of demand, it is a question of supply chain paralysis. This is a political decision that creates a structural barrier to the normal circulation of metals. Tariffs on short-term payments cannot be avoided. If the metals do not economically cross the Atlantic Ocean, the metals cannot be rented from central banks. The bank's normal tools for keeping prices down no longer work when the underlying problem is logistics. Therefore, this week could be a catalyst for a breakout of the paper market. Greenland variables. Let's talk about the question that everyone knows. The entire tariff structure will theoretically depend on the negotiations in Greenland. The government has made this very clear. An agreement is reached in Greenland and tariffs disappear. If no agreement is reached, the 10% interest rate will rise to 25% by 1st June. So the obvious question is, what are the chances of a deal? I have read everything I can find about the Danish government's position on Greenland's own political situation in a broader geopolitical context. This is my personal assessment. The probability of reaching a comprehensive agreement before June word is less than 30%. Here's why. Greenland is more than just real estate. This is a question of Danish sovereignty. This is a cultural issue. For Greenlanders, this is a strategic issue for the EU as a whole, because if the United States controls Greenland, it will fundamentally change the balance of power in the Arctic. It's not like buying an office building. You can't just write a check big enough to close a deal. Some political groups in Denmark would rather see the government fall than sell Greenland. Some Greenlanders consider the sale a betrayal of their autonomy. What is more important is that there is no sense of urgency on the European side. From their point of view, they can wait for the tariffs to expire. They can endure financial pain. They can expect a change in U.S. politics after the next election. They play long games. The government's short-term strategy means that the likelihood of negotiations failing is much higher than market expectations, and every day without progress is one step closer to the implementation of the 10% tariff. The chart doesn't tell you. I want to talk about one thing that drives me crazy: the way most people analyze the precious metals market. They look at price charts. They look at technical indicators. They draw trend lines and Fibonacci pullbacks. They predict their next move based on formulas. These are quite good in the regular market. For the most part, it works well in stocks, forex, and even gold. But silver is not a normal market. Silver has a physical supply limit, but it doesn't show up on any chart. You won't see geo-arbitrage traps and candlestick patterns. You cannot draw a trend line to predict a major event. The price shown on your screen is a derivative of the derivative. This is a futures contract based on a spot price based on market assumptions about metal flows that may or may not be real. When this background stream collapses, the chart will not give you a warning. The chart shows $89.94. The index is down 1.62% since Friday's close. On the surface, everything seems calm, but underneath this surface, the physical market is stuck. Dealers widen spreads. Refinery orders have become congested. Industrial users panic to buy because they know what will happen next. This information doesn't appear in the charts until it's too late. When the graph reflects the actual situation, the movement has already occurred. You don't go in for $90, you are now chasing 110. That's why I'm going to focus on physical inventory data, spreads, and shipping patterns, as these are the most important indicators that really matter. Charts are lagging indicators. It tells us where we have been. It doesn't tell us where we're going, the two-way world we are stepping into. Let me give you an idea of what the next 3 months will look like if this tariff remains the same. By the beginning of February, we are starting to see a continued premium for London's physical silver compared to New York. At first, it is small, about 2% or 3%. The mainstream media calls it a temporary turmoil or regional supply restrictions. By March, this premium increases to 5% or 6%. Retailers in London charge $100 per ounce, while New York still trades for $95. Arbitrage traders see this and say, why don't we send the metal straight from New York to London and grab that $5 spread? Then they will remember the tariffs. They remember that sending an ounce to London means paying a duty of $9 or $20 to return it. They find that arbitrage simply doesn't work. If the Greenland agreement is not reached by May, we will see a difference of 10 to 15%. London silver coins cost $120, New York silver coins cost $105. Then the LBMA has to make a choice. Will they continue to allow the service with these expensive entities, or will they carry out a cash settlement? If they decide to pay in cash, trust in the entire system disappears. Anyone who has the London Silver Treaty understands that their contract is not based on physical metal. This is just a paper promise that can be paid in fiat currency at the discretion of the exchange. If this happens, the physical flight accelerates. Anyone who thought they owned silver through ETFs or vault storage systems suddenly realized that they were entitled to silver, not real silver. And the metal insurance you get becomes vertical. This is the bivalent world we are stepping into. The price of paper silver is one, and the price of physical silver is another, and the difference between them is growing all the time. Everyone ignores the factor of industrial demand. Here's something that doesn't get enough attention in these anxiety situations. Industrial demand for silver is not optional. It's not about investment needs. Someone can decide casually, well, I'm waiting for a better price. If you are a solar panel manufacturer, you will need silver. If you're making semiconductors, you'll need silver. If you manufacture medical devices, parts for electric vehicles, or military equipment, you will need silver. And you need to have a fixed schedule. You can't just say to the production line, sorry, we're going to stop for 3 months and wait for the price of silver to fall. Your contract has a deadline, your customer has an order, your factory has costs. So what happens when industrial buyers find that the normal circulation of comic book silver to where they need it is interrupted by a 25% tariff? They panicked when they bought. They lock delivery at all costs. They create buffers for inventory that they wouldn't normally carry because the cost of running out of inventory is higher than overpaying. And this industrial auction, this unfavorable demand, is the key to the collapse of the market. Because industrial buyers don't care if the price of silver is $90 or $110. They are concerned about ensuring maintenance. They are concerned about keeping the production line running. When you combine this industrial auction with its geographical arbitrage, which hinders normal supply flows, prices skyrocket without reacting to normal market dynamics. Banks can sell all banknotes short. It doesn't matter. Industrial buyers need physical metals, and they are willing to pay any price to get them. Why? I'm not worried about breaking. This week, I'm going to make a prediction that may sound a little counterintuitive considering everything I've just said. I don't think there will be a collapse this week. I don't think silver will fall back to $70 or $60. Here's why. The market is not yet fully aware of the existence of tariff traps. Most participants still assume that this is a negotiated strategy and that it will be resolved by 1st of February. But those institutional players who have smart money and real marketing of physical metals don't sell. They held on. They're waiting to see which way this goes. As long as the physical holder does not sell, the price has an outcome. Will we see it's just a bluff headlines drop to 85? Absolutely. I am preparing for this situation. But if it collapses completely back to the 70s, I don't see it. The physical demands are too high. There are too many industrial procurements. Large owners are too aware of structural changes. The downside risk is limited. The upside risk is unlimited. It's a risk-reward combination that I'm really happy with. My message to paper dealers, if you are a person who trades silver futures, uses leverage, and makes short-term profits on the paper market, I would like to say a few words to you directly. You are playing a game that is about to change the rules in the middle of a round. Normal mode is no longer applicable. Normal support and resistance levels don't matter. The normal correlation with the US dollar, gold, or stocks is collapsing. When trading geo-arbitrage scenarios, technical analysis is almost useless. You don't change emotions or momentum. You change logistics and practices. If you are short on this trade, whether it is a cover call or another bearish strategy, you need to understand that your risk is no longer symmetrical. The downside could be $10, the benefit can be $50, and the marginal call attorney doesn't care about your paper. I am not telling you to close your seats. I'm not giving you advice. I'm just saying what game you're playing. Understand that the referee can change the rules. Know that the result may collapse or the ceiling may fly off, and the stop loss may not protect you. If it doesn't scare you, change it. But if that scares you, you might as well not participate in this game. 14-day countdown. There are only 14 days left until the 10% tariff officially goes into effect on 1st of February. With LBMA, it takes 14 days to get the metal. Banks need 14 days to make the transition. Greenland negotiated for only 14 days. Either an agreement was reached or collapsed completely. It takes the market 14 days to understand what happened. I've been in this industry for 12 years, and I've never seen a lineup like this. I have seen difficulties with supplies. I have seen price manipulation. I have seen regulatory changes and demand shocks. But I have never seen a single policy decision that immediately creates a structural obstacle to the normal functioning of the global raw materials market. This is not based on investment demand, inflation fears, or the weakening of the US dollar, which predict silver rising to $100. This is because the water pipe is broken. The pipeline that originally allowed silver to flow from New York to London was suppressed with a 25% tariff, and no one has yet found a way to dismantle oppression. When a water pipe breaks, the pressure increases. Even if someone wants a higher price, that's not a bad thing. It's okay if the bank tries to suppress it. Physics doesn't care about your short job. The point is, let me take this thing home. It's Sunday evening, January 18th, 2026. The price of silver is $89.94. The market is calm. The mainstream media talks about Greenland, diplomacy, and geopolitics. Amid these voices, the LBMA's liquidity trap is gradually tightening. Within 14 days, the price of silver across the Atlantic will increase by 10%. In less than 5 months, this cost can go up to 25%. Banks moved millions of ounces of goods into U.S. vaults, thinking they were imposing frontline import restrictions. Instead, they imprisoned themselves. LBMA, University of Notre Dame Museum in London, is short. COMEX is the only source, and the door between them is closing. I held my physical silver coin in my hand. I'm going to follow the trigger I just mentioned and prepare to face a market that could actually go above $100. Not because of the hype, but because of the math. You have the information, you've seen the numbers, you understand the mechanism. What you do with this information is entirely up to you. But don't say you haven't been alerted when you wake up one morning and find that silver is trading at $115, all dealers are sold out, and the premium is 30% higher than the spot price. You're still wondering how you missed this opportunity. This weekend sent a signal. The question is, are you listening? If you want to understand how banks set this trap in the first quarter of 2025 and how they transferred large sums of money before the Section 232 review, I'll link in the description to an in-depth discussion of this topic. But now, attention has to shift to the next 14 days. The clock is ticking, and the valves are already tightening. Once the system is fully sealed, the truth will be unavoidable. We'll finally see how much physical silver actually exists versus how much has been promised on paper. I suspect the gap will shock more people than they expect. Stay sharp, watch the data, and trust the math.